Hey everybody, I'm Derek. I am your host tonight, for better or for worse. We are going to be talking about SVB and banking and all that fun stuff. I will also say that if you have burning questions about like what's going on in the space, hey, I'm a CEO, I'm a founder, I'm an executive, I'm a CFO, I have a small business, what should I do? You're in the right place. We have enough time and kind of people here and that we'll be able to answer some very specific questions from you. So as you come up with questions, et cetera, feel free to write those down, and we'll try to get to them. For those of you who this is your first time, we start the night off with a couple of quick hits from around the crypto world. Normally, that's what this kind of format is about. It's about what's going on in the crypto, the Web3 world, and how it actually impacts our everyday lives, rather than just financial investors, trying to make money go up. And so that's normally what we do. And then after that, I'll talk about a topic for anywhere from 10 to 15 minutes. And then we bring up some panelists and have a conversation about the topic at hand. Obviously, you're here because the topic at hand tonight is what all went wrong, roughly 10 days ago. Is that the timeline now? It feels like forever ago, but also it feels like yesterday all at the same time. But so let's jump into some quick hits. Oh no, there's a delay here, so it's like, all right, Arbitrum token drop. Who knows what Arbitrum is? Awesome, you're in the right place. If you have no idea what Arbitrum is an L2 sidechain. No, I'm kidding. It is kind of a fork, if you will, a layer on top of Ethereum. How many people have heard of Ethereum? All right, cool. So think of Arbitrum as a layer on top of Ethereum, just like your credit card is a layer on top of the cash layer of the US dollar, right? And so Arbitrum's kind of like that. They're dropping a token soon, which is really nerdy and will be interesting, but that's happening in the news. A little bit more interesting than that, even to people who may not understand all this crypto stuff and Web3 stuff, is this thing called Ripple. How many people have heard of the company Ripple? So they had a cryptocurrency called XRP, which was primarily for cross-currency kind of exchanges. So rather than going to an exchange rate or whatever, you could actually exchange through Ripple. It was one of the first cryptocurrencies with a real use case and some substantial adoption. And they've been in trouble and in court with the SEC for quite some time now. That ruling has been, kind of 2.5 years, 3 years plus in the making now, and is expecting to drop at any moment now. Right? I think the SEC in New York and the Attorney General of New York are racing to see which ruling can happen first, Ripple or Trump. And so that's going to be a pretty fascinating week in news, because also literally an hour ago, SushiSwap. How many people have heard of SushiSwap? Uniswap. It's basically an exchange where you can say, I have Bitcoin or Ethereum and I want token X, right? Or token Y or whatever. I'll give you Ethereum, you give me token Y. It's a decentralized, quote unquote, exchange. They are the first decentralized exchange under Gensler's reign to be issued a subpoena, which is pretty fascinating. How do you subpoena a decentralized business? Well, come to find out, maybe they're not as decentralized as maybe people thought they were, or it's been issued to the company. What relationship does the company actually have to the application that's running on multiple nodes? Blah, 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 blah. It's pretty fascinating. So between those two things, it's going to be a wild ride in the regulatory space as far as crypto goes, and probably over the next couple of months, we're going to have some interesting decisions and discussions in the crypto regulatory space. And then kind of a segue into what we're talking about tonight. How many people have seen Balaji's, or know who Balaji is, first of all, but secondly, have heard about this $1 million bet? Not a lot of people. That's kind of surprising. It's been a lot of news cycles lately. So basically, this gentleman, he's like Tech Moses, right? He's like the nerd Kim Kardashian or something. Maybe Kim Kardashian, as it were. And so Balaji used to be the CTO of Coinbase. How many people have heard of Coinbase? All right, cool. So he used to be the CTO of Coinbase. Very well respected, etc. Well, he got into a Twitter argument because that's basically all you can do on Twitter nowadays. Shout out to Elon. And Balaji and this other gentleman got into an argument about whether or not we were entering the phase of what's called hyperinflation, which is when the dollar is going to be basically worthless. The banking crisis is maybe a cause of that, maybe an effect of the cause, which we'll get into. But Balaji's kind of hypothesis here is that the US dollar is going to hyperinflate. And if it does, or when it does, in his point of view, that means that Bitcoin is going to skyrocket as a hedge against inflation. And so the reason it's $1 million bet is because he has put up $1 million of his money in US dollars against one Bitcoin, which means that he's betting that in the next 90 days, 3 months, this isn't like 4 years from now, 10 years from now, a year from now even, he's saying in 90 days, Bitcoin is going to be worth $1 million per coin. That's his bet. That happened this last week as well. So as you can see, quick hits are always a little fun. All right, let's talk about banks. The most interesting thing in the night. Come on, thanks. Small group, come on. That's hilarious. I don't care who you are. So how banks work. How do banks work? Right? You put your money in, you get your money out. That's how they work, right? How do they make money? Well, you put your money in, take your money out. Somebody else puts the money in, they take their money out. How do they make money? Well, it just so happens that it's something like this. And excuse the currencies, this is the best I could find on the internet without having to make it myself, or asking Sherry, our designer, a bunch of to make something. But what you'll see here is in the center. Oh, we're in business now. Bank A. All right. So Bank A is the bank that we're looking at. This is how banks make money. So you are person A. Congratulations, you have 100 pounds. 90, I don't know, $5, right? Eat it, euro. So you've got $95, 100 euros. You put it into a bank. You put it into Bank A. All right, my money is safe. I'm putting it into the bank. Eventually, because you have you've opened a cool account that has a 2% interest, right? Your incentive for putting this money into this bank is this interest, right? So this is kind of like a referral fee that they pay you, okay? At the same time, this bank is regulated, which means that it has what would you say, an obligation to keep some of your money, this 100, let's just use dollars because America, it's $100, you have to have some fraction of this $100 in reserve. Our modern banking system is what is called a fractional reserve system, which means that every bank has to legally, from a federal perspective, have some amount of money in reserve, in savings, on hand, in cash, under the mattress, so to speak, from all of the deposits. Make sense? Yes? All right, cool. So in this example, there's a 10% reserve, and the Federal Reserve starts to help set these parameters, right? What fraction needs to be on hand, et cetera. And as a part of this, there's other fees, right? One of those other fees may be to this agency that 3 weeks ago you didn't know existed, but now you've heard of ad infinitum, the FDIC, right? So part of this this bank's obligations is not only to keep some amount in reserve, it's also to pay fees and insurance to other entities, one of which being the FDIC, at least here in this country, right? So don't think that your tax money is backing up your bank dollars, right? The banks actually pay for your tax money or for your deposits to be insured. And so, and that's actually important for a number of reasons, but we probably won't get to that. But so everybody follow so far? So above this line, this is all you and the bank. The bank takes your deposit, pays you, promises to pay you interest. They set aside some reserve. All right. Meanwhile, what do they do with the other $90 that they don't keep in reserve? Well, they make a loan. And person B, right? Maybe a friend, maybe an enemy of yours, maybe someone you don't even know, right? It's just another customer of the bank. They pay back this $90 with interest, which means $106.20 gets paid back. That's the $90 plus interest. Follow? How many people wanted to come to math class tonight? All right, cool. $106.20, which yields $14.20 profit. It's like, what do you mean? I gave out 90, I took back 106.20. Why didn't I get 16.20? Well, remember this over here? You got to pay the $2 interest, right? So you take the $2 out of the 16.20, 14.20 is profit, and it goes back into the bank. Congratulations, you're not just a bank, you are a business. And guess what? This deposit was a 0%, zero maturity loan. You ever thought about that? That as a depositor into a bank, you are essentially, it's more complicated than that for obvious reasons, but you are essentially giving the bank a 0% interest loan, so they take your money and go do with it what they want. 10% is
2%. You're paying interest 2%, so it's a 2% loan.
Yes, that's fair.
And this
in this example, there is the referral fee, right? So otherwise, you are loaning, regardless of what the interest rate is, right, to the bank. All right, and so they get to do this green box is what happens when you make money. Okay, or with the bank makes money from it. Check out, yeah. All right. So what happened at SVB? Right, with all of that kind of rattling around our head, what happened at SVB? So in addition to loaning the capital out, remember that green box? That's how banks make money. They can actually make money in a number of ways. Loaning it out to other people via mortgages, credit cards, etc., is one way to do that. Starting businesses. I'm not saying that loans or credit facilities are unimportant. In fact, they are the backbone on which the American economy is built. Right? Credit is important. Loans from banks are important, and it is good that banks are able to do that. In addition to doing that, SVB in particular also made some investments with that money. Also, a general good thing. They invested in a number of bonds, which are, think of them as promises or kind of like loans. They're fixed income instruments that have a maturity date, they have an interest rate, et cetera. So they made some long-term investments, some of which were mortgage-backed securities. If that rings a bell, it's what caused the 2008-2009 crisis. But that's not what happened here. Everything up until this point, right, is completely kosher. SVB is trying to make money off of deposits that have been put into its bank. They invested in bonds, which are typically fairly safe instruments to invest in. But then a couple of things happened. These long-term investments that are typically safe, they became problematic, right? They became problematic for two primary reasons. Number one, interest rates and bonds, which we'll talk about. And then number two, layoffs in the declining tech sector. How many of you go to sleep, not just when I'm talking about banking, but when some talking head on TV talks about rising interest rates, right? I do it, you do it, yeah, the bankers do it, right? It's like, why does this matter? Well, one of the reasons that it matters is when interest rates go up, bond yields, which is the return on your investment, typically go down. The reason for that is very straightforward. Because if I give you a coupon, a bond today, and I say, hey, I'm going to pay 2% interest on this, right? And then some guy over here, this guy, you get to be the reserve today. The reserve says, you know what? We're going to raise interest rates across the board. Interest rates are no longer 2%, they're now 5%. You can come to me and say, hey, I want a bond that pays 5% interest. Why would I get 2% back on the same amount of money when I can get 5%? Now, how much is his bond with a 2% contract baked in? How much is that worth now? Nothing. You could go get a new bond that pays back 5%, right? Say, hey, I've got two options for you. You give me $100 now, and literally in 30 seconds, I'll give you $102 or $105 back. Which one do you want? That's what happens when interest rates rise, is bonds, their rates go down, like the value of the bond goes down. And so here, SVB had all of these long-term assets on their books, trying to make money from them over a certain amount of time. And the Fed raised interest rates across the board, which rendered a lot of these bonds not useless, but they weren't making as much money as they thought they were going to make. All right, that was the first problem. The number two problem in SVB in particular is the over-indexing on a certain sector, right? They were primarily serving the tech sector, not just VCs, rich capital people living in Atherton, California with massive mansions or whatever. They were helping startups, small businesses, entrepreneurs, right? VCs that were the good kind, that were building and helping to build these small businesses as well. And what ended up happening was, in conjunction with the interest rates being raised, which made all these bonds go down, startups started to get scared, rightfully so, because the economy was starting to slow down, right? And typically, when things are moving fast, you can actually borrow money very cheaply, right? It doesn't cost you a lot of money to borrow money. You could borrow money cheaply and actually sometimes run off of that money. You could put that money to work to make extra money elsewhere in other instruments, et cetera. But now the tech sector, because of the depressed economy, right? The tech sector started to say, whoa. I can't borrow money anymore to start to operate my business cheaply and keep this cash in reserve. I need to start operating off of the cash in reserve, which means that some of the cash that was typically in the bank started to leave, which means less money inside of the bank, which means less money that the bank could make money off of. Make sense? Yes? These two things led to SVB's downfall, but these two things alone didn't cause it. And it's important to know that. It's important to know that these two things happen to every bank, not just SVB, right? Happen to a lot of banks that made safe long-term investments. The interest rates rise, right? That's a fairly common cycle in the American economy. This should not have taken anybody by surprise. What did happen, however, so to give a visual of what I just talked about, the green box became red. They started to lose money, right? No big deal, right? This happens all the time. Maybe you're not making as much money, et cetera. This happens to banks, et cetera. Right? Right? This was the problem. Everyone found out. And it wasn't just that everyone found out. That's not typically a bad thing when banks are transparent, when the financial system is transparent. The bad thing was how they found out and what the messaging was behind them finding out. SVB basically panicked, said we need to raise money right now because we don't have enough money to pay out these people who are trying to get their deposits. And now all of a sudden you have the makings of a good old-fashioned bank run, which is way worse than a good old-fashioned pig pit, let me tell you, as the guy from the Carolinas. So what happened here was that this caused a panic on the bank. And so wait a minute, inflation rates are rising, bonds are cheap. Maybe they have junk bonds. Oh, the tech sector is depressed now, they have to withdraw their money, and they're raising money. They must be in a lot of trouble, even though they had 200+ billion assets on their books, right? And the percentage loss just allocated to their bonds is a little over 1.5%, which in the grand scheme of things it was serious, but not kind of disastrous. And so what happened was when they communicated this, panic started, and it just so happened to fall on a Thursday and Friday heading into a weekend where information starts to get constricted. And not everybody knows what's going on all at the same time, et cetera. And so over the weekend, the FDIC had to get involved, and by Monday morning, we had the debacle that was the bank collapse of this. All right. So One of the biggest differences between finance and fiat, which is the traditional system, the traditional finance system, and the banking system in crypto, or the potential banking system, because there's not really one yet, to be honest. The potential in crypto, the financial system in crypto, is who you trust, right? So in fiat, our entire financial system is built on trust. It is built on, why? Well, let me read the question. Why did the banking sector go haywire after the FDIC said they would rescue everyone? So rewind. Sunday afternoon, the FDIC came out and said, you know what? Our insurance policy against all these deposits is $250,000, right? Per deposit. We are going to insure more than $250,000. We're going to make sure that everybody gets 100% of their money back. Why did that cause the problem? You would think from the outside looking in that when the FDIC said that, the banking industry would have said, that was close, right? But that didn't happen. In fact, the opposite happened. Why? Because depositors are not investors. So the stock market is the people that own the banks, right? That have shares in the banks, that are running the banks. They are looking at what the FDIC had said and said, investors, you're on your own. We're going to look after the depositors, right? There's not a bailout coming for the investors. There's not a buyout coming for SVB. We're going to take care of the people who had their money in the bank and lost their money in the bank. And bank, you're on your own. And so what do you think that does to all of the other banks in the system, right? That's when you saw the panic that we saw. The world's current financial system is built on promises from the government, our financial institutions, and each other, right? You have to trust people and institutions built by people and run by people and ran by people. You have to trust people. It's called fiat, right? The traditional banking system is called fiat. What does fiat mean? Anybody know? Decree. I say it, therefore it's true, right? In theory, this will never happen in practice, but in theory, if a bank was falling and everyone came out, even if they had like zero assets on the books, if everyone came out and said, hey, everything's fine, the reserve said it, the bank people said it, everyone said it, and people believed it, there wouldn't be a run on the bank. Why? Because it's fiat and people trust governments, institutions, and other individuals in this economy. As opposed to crypto, where you don't have to trust someone, you have to trust something, and that thing is code, right? And that is the fundamental difference between a financial system in the fiat world and the financial system in the crypto world. All right, speaking of trust, when I have two folks, so we can go a little bit deeper, come up, that I trust in this area. Shaun Rowles, who has spent, what, 10, 15 years in banking now?
23 years in
investment
management.
23 years in investment management. You're also a guest lecturer here at Vanderbilt.
For 10 years.
For 10 years, perfect.
Applied macro, the fun stuff.
Yeah, so if you didn't take your pillow out and blanket yet, now is the time. Applied macroeconomics is coming right up for you. And Phil, you're at Studio Bank, yeah?
Right.
Yeah, why don't you give these guys a hand as they come on up. Very cool. You can find them on LinkedIn at those / names. Feel free to shoot them an email over and over and over again, asking if they need development service, or if they're hiring. Hey, you want to give a brief intro in addition to what I just said?
Yeah, so I got real excited in the past couple of minutes. I wrote a book all about this topic a couple of years ago. So if you're interested, look it up, and it's a short 4.5-hour read and give you that whole arc. How did we get to here? And what's going to happen now that we've got blockchain? So I'm Shaun Rowles. I run a specialized team of asset managers for one of the world's largest wealth management companies. We kind of had a front row seat on all of this stuff, and I can talk about it in like great length. And one of the big questions is, was the management team at SVB, were they a bunch of clowns? Did they like make crazy mistakes? Or was this more just like a really unique set of circumstances? And the answer is like somewhere right in the middle between these two. I'll tell you, I was talking to Phil before we got here. So one of my passions is big data analysis, and I kind of pioneered the work of using big data and predictive analytics to get a better idea of what's going to happen in financial markets. And so we built a custom model specifically for regional banks about a year ago for one of our clients who had big exposure. And what was really funny about the data model is it was showing reasonable roads 3, 5, 10 years out, but for the first 12 months, it was showing really bad negative numbers. And we were kind of, like, you know how big data is, it's like you don't know exactly why it's telling you exactly what it's telling you. But anyway, so we kind of had that. I use that, I'm a macro guy, so I use that kind of top-down analysis to figure out how to run money. My co-portfolio manager is bottoms up, right? So he's 10K by company by company. So long story short is we all agreed that we didn't want to have exposure to financials because of what we were seeing. As an investment manager, half of our business is managing for institutions. So we manage money for community banks, regional banks, insurance companies, government funds. And so one of the things that we were privy to is talking to C-suite executives of the banks. And last year, no problems. Like you could tell it was towards the end of the year, there was a little bit of sensitivity. And that really changed at the beginning of this year. And what they were all saying was they were experiencing what's called a liquidity squeeze. So liquidity was just flowing out of the bank, right? And what was flowing out is low cost deposits.
Shaun, what's liquidity?
It's the low cost deposits. It's all those $100 that were being deposited into the bank in the chart. So when you make that deposit, there's no time constriction on that, right? You can come back and get it whenever you want. Well, ironically, all that money just sat there all of last year, despite the rising interest rates, right? Well, somewhere around the turn of this calendar year, all of a sudden that money woke up and was like, wait a minute, we can go get 4.5% over here, and the banks were paying next to nothing. The banks had gotten used to the fact that over a decade of low interest rates, depositors had been trained that they don't earn any money on that money. And so nobody was asking, right? But once all of a sudden people started seeing, wait a minute, I can go get 4.5% versus 0.01, they started moving the funds. And I was a part of that. Like that was part of our things, telling people, hey, you're not earning anything over here, and get you 4.5% of treasury, safest investment on the planet. So what happened is the money started sucking out, right? By February, we were hearing from the C-suites of the banks, and they were saying, hey, look, we're conservative, we're fine, but someone's going to fail and it's going to kick off a series of bank runs. And so now all of a sudden, like, you've got our attention, right? So we're really paying attention to this. With SVB in particular, they were also a victim of like their circumstance because of the demographic that they were their primary client. Those clients were flush with cash. Their deposits grew at an exponential rate, but nobody needed loans. They didn't want loans. And so what they did, theoretically, they could have gone out and bought loans, but they had a really low loan coverage. But they had all that cash. So what they did is they bought investments. They put it, when you're managing money for a bank, you can only buy bonds, right? That's what you can invest in. So they went and they bought bonds, but they did it in a big way, right at the kind of, depending on which way you're looking at this, the bottom of interest rates or the peak in price, same thing. And then, so what happened is as the Fed aggressively lifted those interest rates over the past 12 months, they were experiencing this loss in value. No big deal, because banks have a special accounting that they can do, which is hold to maturity bonds. If I'm going to hold it to maturity and I paid $100 for it, I get to hold it on my balance sheet as $100, even if the current market value is only 60, right? So this is what's created this huge unrealized loss in the banking sector. Again, it's no big deal. But SVB,
Unrealized being they haven't
it
put it on the books yet.
Yeah, it doesn't matter. It's not on the books. SVB started to experience the flow out of assets. They did a failed cap raise. All of a sudden, they found themselves in a liquidity squeeze. They needed cash, and they didn't have a way to get it. So what they had to do is they had to take some of those hold to maturity bonds and they had to sell them. When you do that and you sell one bond in that portfolio, the whole portfolio gets marked to market value. So what this did is this instantly changed their solvency metrics. So prior to needing to make this sale, they were passing the test. After this, they no longer pass the test, right? So this was the big deal. The bigger deal was that 96% of the deposits at their bank were over the FDIC insurance level. So this means a tiny amount of money was actually covered. This is why that announcement that came out on Sunday was such a big deal. Because essentially you just had, like I was telling Phil, I flew to LA last week to meet with a VC fund who had just raised funds but hadn't actually deployed into their companies that they were going to invest in yet. And all of that money was at SVB. And for that weekend, they were toast. I mean, they were just out. And the news came, which was, it's funny because to me, this is like the Super Bowl. This is way more exciting than March Madness for me. So that Sunday, I'm like just sitting there, just refresh, because I get the direct feed from the Fed, refresh. And then there it was, and I was like full backstop. Like you kind of figured that was what it was going to be, but anyway. But what that did is last week it kicked off the wait a minute, who else could possibly look like that? And that's what we've been dealing with since. Okay, so that was probably too many words, and now I'll let Phil talk.
No, you're good.
Yeah, I think you guys have both done a great job explaining what the problems were with SVB, and there are going to be other banks that were taking similar risks with these long-term investments, even though they had short-term deposits. Everyone wants their deposits when they want them. So there probably are going to be more bank failures. I think if I had been talking about this a week ago, it's maybe a little different about how I talk about it today. But real quickly, my background, I spent a couple years in investment banking. Spent a couple of years as running a division of a food company, so more of an operational role. I left that to start my own business called In-Crowd Capital, which was an angel investment network here in Nashville. Launched that in 2012, sold it in 2018. And I still manage the portfolio. We don't invest out of it anymore, but we have a portfolio. We invest in about 20 early stage tech companies. So my background is not banking. This was my first commercial banking. Investment banking is more like merger and acquisition advisory. But more commercial banking, I've been in studio for 4.5 years now, where I launched tech and entrepreneurship banking. So all my clients, now studio is very diverse. I like to put that in there. We're not only in tech. Tech is my world. That's the business that I run in studio. It's just one part of the bank. But all my clients I'd say 90% of my clients are early stage tech companies. And then we've got retail and other entrepreneurs, founders, who run different types of businesses, but I work very much in this tech and entrepreneurship space. So my last weekend was pretty crazy, but it was a little bit different. I hate to see bad things happen in tech. I like to start that way. SVB going under was scary for everybody. And if those people had lost their money, that's bad for everybody, the entire ecosystem. In saying that, fortunately, because of the relationships I have with a lot of these tech companies, and the reputation we've built at Studio, we're much more hands-on with our clients. We have been a beneficiary of it. A lot of those companies at SVB are moving to banks like Studio that they're more comfortable in. Most are moving to Chase and these other big banks. But we have a product called ICS. Has anybody been hearing about this? Because I want to give people practical applications, like what can you do today to protect your money? ICS is what it is. It stands for Insured Cash Sweep. And really what it does is it spreads your money out for you. So if you have $2.5 million, maybe you're a startup or something like that, you've just raised $2.5 million. Instead of trying to put $250,000 across 10 banks, which there are startups I know who've done that, and then they have to manage back and forth between all these banks, they can just use the ICS product at one bank, and then that product, like at Studio, we send that out to other banks. It's all automated. The access to the capital doesn't change, so they don't have to go from bank to bank to move money around. They have access to their full $2.5 million always. And if something were to happen to Studio, and we can talk about how great a shape we're in, but that's not what I think you all are here to talk about today. but if something were to happen, then the next day, within 24 hours, or 24 business day hours, because as we know, SVB failed on Friday, so it was Monday before the access to capital, even if it had only been to 250,000, wouldn't have been available till Monday. The next day, you would have access to every dollar, not just 250,000. You would just be a customer of a different bank. And that's how the FDIC thing works. Now technically you're a customer of Silicon Valley Bridge Bank, but it's technically a different bank. So that's kind of how ICS works. I'm happy to go into more of the detail there, but I wanted to make sure that entrepreneurs know there is a way to get this type of product, whether it's at Studio or at other banks. Not every bank offers it, but most do. Some have limits. We were talking Mercury's is, I think, 5 million. It costs banks, or at least in our case, it costs us 15 basis points of 0.15%. But we don't pass that on to our clients. There are some exceptions, like some of these are money markets, which means we pay you interest. So if you're earning 3.5% interest on your business and you want an ICS product, I'm probably paying you $335 instead of $350. But other than that, you can actually have the ICS product and get paid to use the ICS product. Because I think that's the first thing the entrepreneurs think is, well, if I have life insurance, it's $500,000, and now I'm getting life insurance for $1 million, I have to pay more for that. This is different. This isn't like that. This is a product that can fully insure your total balance, and it shouldn't have a cost to you at all. But I'm happy to answer questions about the banking side and get more specific about what happened at SVB. If you have questions about what you should be thinking about when you're choosing a bank, if you want to move banks or you're trying to find a bank that makes you feel comfortable, happy to talk about that stuff as well.
So the funny thing about all this is, all of a sudden one day everyone woke up and realized there was a risk, right?
Yeah.
And it's really funny, but that's kind of how these things work. So is the risk over? Is kind of the big question. So just about every institution is doing some version of the here's our expanded facility for FDIC. We're doing it, they're doing it, everybody's doing it. But again, your program has a much higher threshold than a lot of what I've seen at other banks. But there's still this differential between what treasuries are paying, and that's the rate that the Fed is setting. So tomorrow when they raise 25 basis points, that's going to be immediately reflected in treasuries. And that's higher than what you can get in any of the deposit accounts, right? Regardless of what its FDIC coverage is or isn't. And so the problem is this kind of general sucking of liquidity out of banks and into the treasury. It's really funny because you actually have the US banking system is in a tug of war with the US government funding system, right? And that's where we're at. And that's not abating immediately. And so that's why you'll kind of continue to hear like discussions of what is the FDIC going to do? Yellen and Treasury, they're debating, do we expand FDIC coverage further? Plenty of argument for they should, but in the meantime, you've got all these institutions that are kind of like patched workarounds for people. But in our case, what we've been doing before this became a topic is we were putting people in the deposit accounts that were FDIC insured and giving them whatever the interest rate is, which wasn't as attractive as what we were dumping into treasuries on the side. And the thing about treasuries is they're the most liquid security, really, really safe, you get them really, really short, like weekly maturities. So we were taking startups and basically who would successfully raise capital in excess of traditional limits, and we were just building out their burn rate in treasuries and all of a sudden getting them in the mid fours for an interest rate. So that part isn't changing quickly. The whole market is repriced interest rates, and so now there's this expectation that the Fed's going to cut rates this fall. We'll see, because inflation isn't necessarily going to cooperate with that. And I can tell you more about why we think that. But the point is, like, this typically when we have events like this, they're resolving in months, not weeks. And so this is going to kind of keep playing out.
Yeah. How many people remember a bank called Lehman Brothers? How many of you were like 3 years old? So how much money do you think was lost by depositors from Lehman? Take a guess, anybody? I'll give you the answer since no one was brave enough in this room. $0. Not a single dollar was lost by a depositor. It took them 14 years to get it back. That's kind of how the system works, is it protects depositors, right? Lose your money. But you might lose your business, you might lose your house, you might lose your livelihood along the way because it takes so long to get that money back. So when you hear this criteria, right, of how much interest rate can I have, how liquid is my money, how readily accessible is my money, which is another way to say liquid, those are the things you have to think about, right? It's not just as simple as an ICS account versus a treasury versus a money market account versus a checking account with no interest, but it's always liquid. There's a lot of instruments and a lot of characteristics that go into those decisions that you should take into account, right? How quickly do you need the money? How quickly do you want to have access to the money? How much work do you want your money to do for you? And so I can speak as an entrepreneur operator. The end of that week, Thursday, started hearing some rumblings in some of the group chats and telegrams and bunches that I'm in with other founders. It's like, hey, something's happening with SVB. By Friday morning, for a lot of folks, it was crisis. We don't bank at bunches. We didn't. We have raised a very sizable seed round. I won't disclose the amount because there's journalists in there. I won't disclose the amount, but it's a sizable seed round, so we are well above that threshold of capital. And our COO at the back, Spencer. Hey, Spencer. And I were constantly talking like, what do we need to do? What should we do? And we came up with two priorities. Number one, protect the money. Full stop. And it sounds silly to say that out loud. I promise you it's not, because as a startup, your number two priority is to put the money to work. As a startup, your whole existence as a small business, regardless if you're making apps or making, kind of SaaS software, or you have a fashion business or a smart hardware business, whatever it may be, your job is to iterate, to innovate, to build product, to ship stuff, and that costs money, right? It costs money to pay engineers, it costs money to pay suppliers, it costs money to market, et cetera. And so part of being an entrepreneur, part of being a small business person, part of being a startup exec is that dichotomy between keeping money safe and putting it to work. And these characteristics of liquid, how much interest rate am I getting, et cetera, those are kind of the different dials, so to speak, that you have at your disposal. So when you hear things like liquidity, think how easily can I access the money? When you hear things like interest rate or payback rate, et cetera, think about how much money am I getting by having this money, right? And so those are the two ways that we think about it. By Sunday, we had decided to open a Big Four bank account with zero interest or near zero interest rate that we did not transfer any money into, and we're not going to transfer any money into. The reality is, as an operator entrepreneur, you sometimes have minutes to make these decisions. And the last thing you want to do is for your rep at Chase or Bank of America or Studio or any of the other banks that you decide to go into business with, your rep to say, hey, there's going to be a processing delay of about 6 hours here. I'm sorry, I can't do anything for you. My hands are tied, et cetera. So, having that backup ahead of time will expedite that decision-making and execution process later on as well. And so these are the types of things that if you own a business, you should think about. It's like, what happens if shit hits the fan and I have to move money out of my failing bank very quickly before the FDIC steps in, right? Because that's the other thing here is that while SVB was failing, it wasn't until they were protected that everything got froze. And that's kind of the irony here as well, is everybody knew that SVB was in trouble, and the conversation Thursday and into Friday was, should we pull our money or not? right? It wasn't until the regulators in the state of California stepped in that you no longer had a choice. And so there's sometimes there's this window where the decision isn't on the government side and the government hasn't made the decision for you, where the bank hasn't made the decision for you. It's on you as an entrepreneur. It's on you as a startup founder. It's on you as a small business owner. It's on you as an individual to make that decision for yourself. And you may only have a couple of hours to make that decision. And so being able to make that decision ahead of time is going to give you some relief when that it proverbially hits the fan. So
Derek had two really good points that I'll hit on. First was last week, it was just a massive move with everybody moving money to the Big Four. And why do you do that? Even if you're FDIC insured, what you're scared of is the liquidity risk, not loss. It's liquidity, right? So if I'm FDIC insured, my bank goes under, I'm going to be okay. I just don't know when I get my hands on the money again, right? And that was the concern over the weekend for SVB. Friday, it was over, it was gone. And Saturday and Sunday, everybody's like, will we be able to access it next week? It looks like we won't. And then they came out and said, as of 9 a.m. Monday morning, you'll have full access.
Let me comment on that real quick. So FDIC insurance does get you access to your funds within 24 business hours that are insured.
So once it's received into receivership. Once the bank.
Well, but FDIC does that within 24 business hours. So the question wasn't, when are the companies going to get their money back? The question was, when are the companies going to get their uninsured money back? That was the question. So they knew that Monday morning they were going to have at least $250,000. Now, to a company that's just raised 25 million, that is not reassuring. The question is, when am I going to get my 25 million? That could have been weeks, months, years.
Yeah. For a lot of VCs, and I'm sorry to keep cutting you off, but for a lot of VCs and startups, like the 250 threshold was payroll for half a month.
Yeah.
You know what I mean? It was like nothing.
So with a product like ICS, I'm going to beat the ICS product to death because I do think it is like the solution or a major piece of the solution. If they had ICS, and I'll tell a quick story. So companies that come to studio, I do set them up with ICS because we're a young bank, we're a new bank, and I know that people are worried about it and their VCs might be worried about it. So they say, well, I could send my client to Silicon Valley Bank, which is a huge bank, and make them bank there because I know it's a big bank and it's less likely to go under than this small bank in Nashville that I've never heard of. So I had this ICS product. So I always had that my clients in that. So I was talking to one company that was at SVB. They just raised I think $7.5 million round, and we were talking about ICS. And he said, SVB won't let me bank at another bank because we have a line of credit there. But he opened an ICS with SVB. So 4%, like he might have been 50% of the 4% of the money that was actually in a ICS. He had nothing to worry about over the weekend. He in fact texted me. Now once Sunday came and the Fed said we're going to backstop everybody, it became a moot point. But he sent me a text that said, "Thank you for teaching me about the ICS because if you hadn't, I wouldn't be making payroll Monday and my company would be dead." But he had ICS. He knew Monday morning he'd have access to what's now about $5.5 million. Now, thankfully, obviously, he's a client. Like he's moved everything over to studio, obviously. But the point is that he had the ICS. He didn't have to worry about when he was going to access his money. He knew on Monday morning he had access to everything because it's fully insured. So I want you to go back to your second point. But I did want to clarify that the uncertainty was around the uninsured money, not the insured money. The insured money you're going to have within 24 hours.
The second point that Derek says that's really important is it's not always easy to get an account open in a new institution that you have no relationship with in 2 minutes, right? And so doing a little bit of that, like building your escape hatch is in advance.
Even if you have a relationship with them, because sometimes, especially
I know
larger
your customer rules and all that stuff is like, it's a little bit more cumbersome these days, and so you've got to go through it. And Phil was commenting about this earlier, and we've experienced the same. I mean, the past week in particular, it's been nothing but opening new accounts, trying to transfer funds, right? I mean, it's just like the fire hose. And so, and a lot of companies still rely on back offices, which are always stretched to be to the end. So anyway, you kind of want to, think ahead and kind of figure out, well, if I come to this issue, what ripcord would I pull? Probably gonna build those down.
Questions? We're gonna open up now. We'll start with Parson.
What does it mean by not using taxpayers' money for covering the crisis? How I get money?
So really quick, we only have a few minutes here. I will answer that in very quickly. The FDIC is not funded by taxpayers. It is funded by fees that member banks have to pay. That money goes into a deposit, it's an insurance company, that's the IC, right?
But because now they're trying to do it for uninsured folks.
Right, and the question is not whether or not they should, it's how.
Keep in mind that, like, what the Fed is thinking here is that this isn't a systemic issue. There are gonna be more banks that go under, but they have enough FDIC insurance to cover, like, it's like $1.2 trillion or something like that. And they're not expecting to have to pay out 1.2 trillion. So they're saying they can fund it, like, that would be if like every bank on the planet went under. So they're saying we have enough money to fund 300 banks that go under out of 4,800 banks. If it becomes a systemic thing, which I really don't think it will. I mean, I know we have 80 people, like our CEO's office is like adjacent to mine. I see all the financials, I see everything, and I'm not worried at all about Studio. So I don't think that like this is gonna be a huge thing. It's gonna be these banks that end up taking on too much risk. Silicon Valley Bank is the first domino to fall because they had way too much money in investments. And of those investments, they had way too much money in these long-term bonds. And those were just too, like they had 50% of their, so when you put in deposits, and we lend them out, when we lend them out, that's an asset to us, we get paid on that. So they had 56% of their assets in investments. Banks are supposed to lend money, not invest it. They thought that they were like the Warren Buffett's of bond portfolios, and they horribly miscalculated. I think we have 20% of our assets in investments, and that's because we just raised $40 million like 6 months ago, so we had to put it somewhere.
The trick there is that the banks basically have to pay slightly below where treasuries are and have to earn slightly above where treasuries are. So if you're not going to issue that in loans, which is really easy to market price, and you're having to go out into the fixed income environment to get that spread above what the treasury rate is, like they had to go way out in duration, the length of the bond, and they had to go on the lower end of their quality side to get the spread in order to be within compliance with how they run the metrics. So it's like, it was just a perfect storm of stuff.
Other questions? Yes, sir, right here.
Were they not marking every time the Fed was raising? I think I heard something about accounting or stuff. Were they just like pushing, kicking the can down the road? The other question I have is, if you're a VC and you're looking for 12x on your portfolio companies, do you really want the bank that you're banking with to be trying to gain their own alpha as well? Isn't the 12x you're hopefully going to
Well,
an exit?
the last question first.
Yeah.
The banks aren't looking to gain alpha on like private equities, typically.
No, I'm saying if you're the VC, do you want your bank?
Yeah, you don't want your bank to be
Playing in
the
the
risk taker
about
as
as
well.
No, well, bonds are not private equity. Like bonds are very stable. They're not high.
I mean, the VC, say, like, if I'm a VC and I'm banking with you,
Right.
I'm worried about the 12x return I'm getting on the portfolio company. Right?
Right.
I don't want my bank playing with that money, right? So is that why the VCs kind of launched the run? It was like, these guys are mishandling.
Well, I mean, to be honest, everybody who was uninsured there was completely ignoring all the time risk that is always present in the
Right.
system and will for all time be in the system unless we completely change it away from the fractional reserve system. Which ironically, Caitlin Long had submitted a fully reserved bank proposal to the Fed and was rejected. So like, she's kind of trying to take it that direction.
Well, the irony too is like most of the crypto failings that have occurred because they were also fractional reserve situations like FTX, et cetera. I'm still not quite understanding the second question then, because like,
well, what he said,
VCs understand that banks need to make money. They're not playing with that money. They're still being fairly
Well,
safe.
I think answering the first question maybe even leads into the answer to the second. So the first
Okay.
question being,
were the traders not watching the increase?
So, yeah, were they
watching it,
marking?
But it was in, like, it's in their basket of held to maturity securities.
So that means like, sorry,
Yeah, so what that means is, so when you're a bank and you go to, you're buying a bond as an investment in your portfolio, you have to make a decision up front. Is this going into held to maturity securities or available for sale?
which means you hold it, you don't sell it.
Yeah. Sure. Once you make that designation, those assets are treated two different ways on your account. Held to maturity is booked at whatever you paid for it, and it's gonna stay there. Even if its market value was $60, it's on the books at 100, right? Available for sale gets marked to whatever the market value is, and that makes sense because that is your liquidity pool. This is supposed to be long-term reserves, not liquidity, right? And so what's happened to all the banks, because every bank has some money invested in bonds. All of them have some money that's in held to maturity bucket. And all of them are experiencing some degree of underwater on that portfolio. In SVB's case, they had to reach into that bucket because they ran out of liquidity. And when they did that, it brought all of that, it basically brought all that loss to current, right?
Now all those bonds were available for sale.
Right, so now they're all marked at what their current market value is, and now all of a sudden, their assets to liabilities just changed.
Yeah.
And now we're.
So their shareholder equity, if you marked all that to market, their shareholder equity is zero.
Yeah.
Was zero.
Now, a lot of
That's
people-
why the FDIC stepped in when they did, because the bond prices kept going, they would have been deep underwater.
But anyway, let's move on a little bit and we can come back to it. There was
It's only
another
until
question
7:30.
over.
Are we cutting off at 7 or 7:30?
2 minutes.
But their tangible equity was zero last summer, so it's like, this didn't just come out of nowhere.
Yeah,
Like,
okay.
everybody was looking at it. Well, not everybody.
Spencer?
So it sounds like you guys are saying we're not out of the woods yet. What is the thing that sort of keeps you up at night the most? The next shoe to drop, or the thing that's possible or likely that could happen next, like the next big problem?
But for us, our anxiety is commercial real estate backed securities. And what we're worried about is commercial real estate's also experiencing kind of a similar perfect storm environment, right? The aftermath of COVID and then just higher interest rates, lower occupancy, and then now tightening in lending standards, which is inevitable when there you have banking liquidity crisis. So that's the piece that I'm watching because, and that happens to kind of also be more prevalent in small and mid-sized and regional banks than it is in the big banks. And so that's one of those ones where I'm somewhat nervous that could be the next shoe to drop. And that is like this environment we just went through was not like 08. But the commercial mortgage-backed securities could potentially be a little bit more like 08. So that's the thing I'm watching the most. Now, I'll say, am I expecting like that next big swoosh down? Right now, I'm not. And again, I've run big data models. Big data models telling me that we're probably going to be okay. We're expecting muted returns this year for equity returns. So I'm not expecting like the market to skyrocket. So this week's little reaction to the news over the weekend is, it's a little more complacent than I would like to see. But that's the piece I'm worried about.
You worried about?
I at first thought this was going to be a very specific problem for SVB, Silvergate, and Signature. I think now people are looking, what happened is people are looking more closely at what the banks are holding. So there are going to be more failures. I wouldn't say I'm necessarily worried about much. I think there are other things that keep me up at night than like what's going on in banking right now. But there are banks like SVB that are going to be in the same situation. They have too much bonds, like the cash is coming out, depositors are pulling their money, and they're just going to go under. To put in perspective, like how bad SVB was at managing that, they're 250 times the size of Studio Bank, and they had 1,000 times more in their bond holdings than we did. And they're just, now we're only 4.5 years old. Like, we're a young bank. We don't have bad loans because they're all pretty new. Maybe I can't say that like on the record. Maybe I have to say there could be, or I don't know. But as far as I know, we don't have any troubled loans. We haven't been losing depositors. We're much more high touch with our clients. My clients call me and email me. I explain the situation, why we're different than SVB, and I haven't lost a single deposit. As far as I know, we haven't lost any major deposits. I know for a fact that we actually gained in deposits significantly over the past week and a half. A lot of that's because a lot of these SVB companies have been coming to Studio. I'm actually, I hate to say, because I hate bad things happening in tech. Like, I think that's bad for the whole ecosystem, but I'm actually kind of excited because we're getting a lot of business out of it. So it's helping Studio grow. Kind of excited.
So I think that the three of us will hang out for a little bit after. Is that cool?
Yeah.
Oh, yeah.
Because I know we're gonna get kicked out soon, AKA now. Thanks for hanging out for a little bit. Before my current startup, I was at a company called Adapar, which is sizable in the wealth management space. I've been a lot of your
Demo
teams.
and some other stuff next week.
It's fantastic. I built it.
Yeah.
It's now $3 or $4 billion privately held company. And the whole point of Adapar was to prevent the next financial crisis. So we spent a lot of time studying things in events like this. And I don't think, what I worry about when I look at something like this, we haven't talked about this, maybe we can or should, but I'm not as worried about the commercial piece. I'm worried about a black swan event. And to date, the US dollar has never had foreign pressure put on it. And so what happens when you have a domestic crisis like mid-sized banks and the uncertainty around the banking services right now, and then you have malicious actors, whether those are other nation states or OPEC or someone like that, see weakness and actually try to strike now by moving the Saudi reserve currency or oil reserve currency from dollar to China, or China and Russia colluding and actually trying to put foreign pressure on the dollar, et cetera. I think that would keep me up at night. I haven't seen signs of that. But
Yeah, we talk about trust being the centerpiece of that whole conversation, and we can have all our frailties, but there's still a big component of trust that's missing there.
it is until OPEC decides to move.
We'll see.
And if they decide to move to the fastest growing economy, China, which large swaths of Africa rely on, et cetera, which are also the fastest growing economies, like it could become problematic. I hope that it won't, but that's what worries me.
We didn't even talk about how the implications for crypto.
Yeah.
Never enough time.
So we're around if you
On
have
that
questions.
super cheery note,
Yeah.
thank you everyone for coming. Really appreciate it.